While you were asleep last night, the United States dropped bombs on Iran, Tehran, Isfahan, Karaj, Kermanshah, nuclear facilities, military command centers, dozens of strikes by air and sea. Trump posted an 8-minute video on Truth Social calling it Major Combat Operations. Operation Epic Fury. Iran fired back within hours. U.S. bases hit, Dubai hit, Doha hit, explosions heard across the Gulf. Israel declared a nationwide state of emergency. And silver, sitting at $94, with COMEX vaults at all-time lows, with the Strait of Hormuz now inside an active war zone, has not traded a single tick since Friday's close. The market has been dark for 48 hours. COMEX opens tonight. Mark here from GoFinance. And what I'm about to show you is why tonight may be the most important silver open in years. Stay with me, because what makes this weekend different from every other geopolitical shock you've watched play out in precious metals is not the war alone. It's what the war is landing on top of. Before the first bomb dropped on Saturday, silver was already in the most structurally stressed position it has occupied in modern market history. COMEX registered vaults, all-time lows, physical delivery rates running at 98%, institutional buyers pulling metal out of the system at 727 times the pace of 2 years ago, London lease rates at 8%, 16 times normal, and a KOT report released Friday afternoon showing the most constructive positioning data of this entire cycle. The geopolitical shock is not creating the silver story. It is landing on top of a physical market that was already operating near its structural limits. That distinction changes everything about how you read tonight's open. Drop a comment right now telling me where you're watching from. United States, Europe, Middle East, Asia. Because this weekend's events have implications for every corner of the global financial system, and I want to know whose company we're keeping going into this open. Let me walk you through everything. 4 things. The weekly close, and what the technical picture is communicating entering March. The KOT report, and why almost everyone covering it is misreading the most important number in it. The Wheaton $4.3 billion streaming deal, and what it tells you about where institutional capital expects silver to go over the next decade. And what happened Saturday, while every market in the world was dark. Let's start with the weekly close. Silver opened the week of February 23rd at approximately $86 to $88. It closed Friday, February 27th, at approximately $93 to $94, a weekly gain in the range of $7 to $8, 8 to 9% on a metal that closed the prior week near 86. The intraday move on Friday alone was extraordinary. Silver came into the session around $89 and closed near 94. A $5 single-day move layered on top of steady gains. Monday through Thursday produced a weekly candle that technical analysts across multiple frameworks are describing as a strong bullish continuation signal. Gold settled Friday at $5,247.90 on COMEX April futures, up approximately 1% on the day. The gold-silver ratio compressed from approximately 58.5 on Thursday to approximately 56 to 57 at Friday's close. That ratio compression matters, and I want to be precise about why. When silver outperforms gold on a percentage basis, it typically signals one of 2 things. Either speculative money is flooding into silver as the higher beta play, or the physical silver market is tightening faster than the gold market. Given what we know about COMEX registered inventory and the February delivery data, the physical explanation is significantly more consistent with the evidence than the speculative one. The recovery arc since the early February low tells an important story. Silver hit a crash low near $70 when the CME raised margins during the first week of February and forced a violent liquidation cascade. From $70 to $94 is a 34% recovery in under 3 weeks. That kind of V-shaped recovery does not happen in markets where the underlying thesis is broken. It happens when a price compression event removes leveraged and weak-handed positions, and then the structural buyers, industrial purchasers, delivery takers, institutions converting eligible to registered, step back in at a price they consider attractive relative to what they know about physical availability. Key technical levels going into March. Resistance at $100, a psychological round number that has never been sustained in the modern silver market. Support established at 83 during the margin-induced bounce and at the $70 crash low. The weekly chart pattern shows either a hammer or a bullish engulfing candle depending on the specific open you use. Elliott wave, Fibonacci retracement levels, moving average alignment. Across every major technical framework, the direction is consistent. The question is not which direction. The question is what catalysts accelerate or delay the next leg. And as of Saturday morning, one of the most significant catalysts imaginable just arrived in the form of active military engagement in one of the world's most strategically critical oil transit corridors. But before I show you the Iran timeline in detail, before I walk you through what Operation Epic Fury means for Sunday's open, I need to show you the KOT report the CFTC released Friday afternoon. Because the positioning data in that report is being almost universally misread, And the correct reading changes everything about how you should understand this move. Stay with me. The CFTC releases the Commitments of Traders report every Friday at 3:30 p.m. Eastern. It covers positions as of the prior Tuesday. The February 27th release covers positions as of Tuesday, February 24th. And what it shows is, in my view, the single most structurally bullish data point of this entire silver cycle. Here's why. And I want to walk through the specific numbers carefully because the misreading of this data is costing people their conviction at exactly the wrong moment. Managed money, which includes hedge funds, commodity trading advisors, and algorithmic funds, held approximately 22,260 net long contracts in the futures-only report as of February 24th. That number was down from roughly 24,000 the prior week. And it is dramatically below the 44,987 net long contracts these same funds held in July 2025, when silver was trading near $38 per ounce. Read that again carefully. Silver is now trading at $94, nearly 150% higher than July. And the managed money position is less than half of what it was at the lower price. This is not what a speculative bubble looks like. In a speculative bubble, managed money positions grow alongside prices as momentum traders pile in. Position sizes expand. Every fund manager who missed the first move scrambles to get on board. Open interest explodes as new speculative money floods the market. What we are seeing instead is managed money getting progressively more cautious, liquidating longs, adding some shorts, while the physical market and the delivery data tell a completely different story about underlying demand. The implication is significant. When and if hedge funds decide this move is real and begin re-entering at scale, they will be buying into a market with depleted registered inventory and a 4-month swap rate inversion. The speculative fuel for a major acceleration is fully loaded. The trigger has not been pulled. That combination, structural physical tightness with speculative money still largely on the sidelines, is historically unusual at this price level and historically very constructive. Total open interest in silver futures fell by 6,042 contracts to 125,454 on a futures-only basis. The combined futures and options open interest fell by 29,771 contracts, a 15% weekly decline to 168,999. That is an enormous contraction of paper positions in a single week. And here is what that contraction means when it happens alongside a rising price. Open interest, falling while price rises, is the signature of physical demand, replacing future speculation as the market's price-setting mechanism. Every contract that closes without being replaced represents a futures participant who decided they no longer want paper exposure to silver, and either took delivery or simply exited. The paper market is shrinking. The physical market is not. Commercial positions, the banks, miners, and dealers who traditionally run the large short side of the silver market, showed continued short covering. Commercial net shorts narrowed by approximately 1,267 contracts in the futures-only report to 41,080. On the combined futures and options basis, commercials reduced shorts by 8,338 contracts, while cutting longs by 6,476, a net short reduction of approximately 1,862 contracts. The commercial short position has fallen from 43,932 in September 2025 to 41,080 today. Banks are quietly reducing their structural short exposure to silver even as prices rise. If they believed this was a speculative bubble they could lean against with new shorts, they would be adding shorts, not reducing them. The direction of their behavior tells you something about what they believe is coming. And the December 2025 Bank Participation Report, which covers the largest U.S. bank positions, showed something with no recent historical precedent. U.S. banks went net long silver for the first time in memory. The entities historically responsible for capping silver prices through concentrated short selling reversed their structural position. They are now net buyers. That structural shift is what gives every other bullish signal in the COT report its teeth. Small speculators, individual retail traders, and small funds below the reportable threshold were the only category adding to both sides of the market this week, increasing longs by 1,676 contracts and shorts by 1,200. For a net long increase to approximately 18,820. Retail is stepping in where institutions are stepping out. That dynamic has a name in commodity markets. It is called the distribution phase of a bull market, where institutional money sells paper to retail at a profit. Except in this case, the physical delivery data suggests the institutional money is not distributing and quietly exiting. The delivery data shows institutions taking physical metal off the exchange in record quantities. What is being distributed to retail is the paper contract. The physical metal is going somewhere else entirely. Let me slow down here for a moment, because I want to be clear about what the QOT data does and doesn't tell us. It tells us about positioning as of Tuesday. It tells us about the direction of institutional behavior. It does not tell us about COMEX positions we can't see or about physical transactions happening outside the futures system. It's one layer of a multi-layer picture, but it's a critical layer. And the picture it paints, managed money dramatically underweight at near record prices, commercial shorts continuing to cover, physical delivery data showing institutional buyers taking metal, is the most constructive combination I've seen at this stage of a move in this market. All right, back to the data. Now let me show you the institutional money move that tells you more about silver's long-term trajectory than any analyst price target. Because $4.3 billion of committed capital is harder to argue with than any forecast model. Stay with me. On February 16th, 2026, Wheaton Precious Metals announced it was acquiring an additional silver stream on BHP's Antamina copper zinc mine in Peru for $4.3 billion. The largest streaming transaction ever executed by upfront consideration. In the history of precious metals streaming, $4.3 billion committed in a single deal. Let me explain the mechanics, because they matter more than the headline number. A silver stream is not a mining company investment. Well, when Wheaton enters a streaming agreement, it pays an upfront amount to a mine operator in exchange for the right to purchase a fixed percentage of that mine's silver production at a predetermined low price, typically $10 to $15 per ounce, regardless of what the market price is at the time of delivery. If silver goes to $150, Wheaton still buys at their contract price and pockets the difference. If silver goes to $200, same deal. The streaming model is the single most efficient financial vehicle for expressing a long-term bullish thesis on silver without taking on operational mining risk. Wheaton's CEO, Randy Smallwood, said when announcing the deal, quality silver production is becoming increasingly difficult to source, while demand continues to rise. That sentence from the CEO of the world's largest silver streaming company, committing $4.3 billion of capital to lock up future production, is more valuable as market intelligence than any analyst price target you will ever read. Wheaton does not make $4 billion bets on sentiment. Their financial models for this deal project across decades. The present value math only works if their long-term silver price assumption is substantially above current spot. Reverse engineering the model based on their contract purchase price and the transaction size suggests Wheaton is pricing silver in the range of $80 to $120 per ounce as a long-term baseline, not a peak assumption. A baseline. The Antamina mine, located in the Peruvian Andes at 4,300 meters, is a joint venture owned by BHP, Glencore, Teck Resources, and Mitsubishi. It is one of the largest copper zinc mines in the world. Silver is a byproduct. Prior to this deal, Wheaton already held a stream on 33 1/3% of Antamina's silver. The new agreement brings that to 67.12%, covering essentially the entire recoverable silver output of one of South America's most productive base metal mines. The deal adds approximately 6 million ounces of silver per year to Wheaton's attributable production profile, financed through $1.9 billion in cash, a $1.5 billion term loan, and existing revolving credit. It closes around April 1st. To put $4.3 billion in context, that is roughly the value of all registered silver currently sitting in COMEX vaults at current prices. One company just paid an amount equivalent to the entire COMEX registered inventory to lock up future production from one mine. And Wheaton is not alone. The Coeur Mining and New Gold merger, a $7 billion transaction creating a producer of approximately 20 million silver equivalent ounces annually, is pending for the first half of 2026. Lemur Royalties finalized a $670 million silver stream from the Fruta del Norte mine, effective March 1st. These are not incremental portfolio adjustments. These are large institutions making multi-decade commitments to silver production at implied prices that assume the current bull market is structural, not cyclical. Before I get to Saturday's events, I want to cover one more piece that received almost no attention in silver media this week, but which illustrates precisely what the supply side of this market actually looks like on the ground. Endeavor Silver reported fourth quarter and full year 2025 financial results on February 27th. Full year revenue came in at $467.5 million, up 115% year over year. A primary silver producer more than doubled its annual revenue in a single year. But buried inside the earnings release was a disclosure that says more about supply constraints than any inventory chart. Endeavor Silver's Terronera mine, a new flagship project that only began commercial production in late 2025, was temporarily halted from February 22nd through February 25th due to what the company described as security events in the state of Jalisco, Mexico. Security events is corporate language for cartel activity. Mexico produces approximately 180 million ounces of silver per year, roughly 22% of global mine supply. Any production disruption in Jalisco, Zacatecas, or Chihuahua hits global supply directly. A 4-day halt at Terranera cost approximately 33,000 ounces in isolation. Multiplied across dozens of Mexican operations facing the same security environment, the cumulative supply impact becomes material. CEO Daniel Dixon described it as a brief interruption. The structural situation in Jalisco remains unresolved. Keith Neumeier of First Majestic argued at a late February conference that silver mining equities are currently being priced as if silver will collapse back to $35 to $45, not as if $94 silver is a new baseline. If $94 silver holds for 2 or 3 quarters, earnings revisions across the sector will be dramatic and upward. Now I need to tell you exactly what happened on Saturday. Because everything I've just described, the Coty positioning, the Wheaton deal, the supply constraints, all of it was true before the first strike landed. Now add the geopolitical dimension on top, and understand what COMEX is pricing when it opens Sunday evening. Stay with me. On Saturday, February 28, 2026, while every precious metals exchange in the world was closed, the United States and Israel launched coordinated military strikes against Iran. The operation was codenamed Epic Fury by the U.S. Department of Defense. The targets included nuclear and military facilities across Tehran, Isfahan, Karaj, and Kermanshah. Trump posted an 8-minute video on Truth Social confirming the operation, describing it as major combat operations aimed at eliminating Iran's nuclear program. Israel's defense minister, Israel Katz, called it a preemptive attack intended to remove threats to the state of Israel. Prime Minister Netanyahu stated the joint goal was to remove the existential threat posed by the terrorist regime in Iran. Iran retaliated within hours. U.S. military bases in the region were struck. Israeli territory was hit with ballistic missile barrages that triggered air raid sirens across the country. Gulf Arab state infrastructure was struck, including targets near Al Udeid Air Base in Qatar and the U.S. Navy's 5th Fleet headquarters in Bahrain. Explosions were heard across Dubai and Doha. Iran's Fars news agency confirmed strikes targeting military bases in the UAE, Qatar, Kuwait, and Bahrain simultaneously. Israel declared a nationwide 48-hour state of emergency. Hospitals in central Israel moved operations to underground fortified facilities. Israeli airspace was closed to all civilian flights. To understand why this happened Saturday, you need to understand the 72 hours preceding it. The third round of U.S.-Iran nuclear talks in Geneva concluded on February 26th, without agreement. The United States demanded Iran destroy its Fordo, Natanz, and Isfahan nuclear facilities and surrender its enriched uranium stockpile. Iran's Supreme National Security Council rejected these terms. Secretary of State Rubio had described Iran's refusal to discuss its ballistic missile program alongside its nuclear program as a big, big problem. Oman's foreign minister, who had been mediating, said the two sides had made significant progress just hours before the bombs fell. By Saturday morning, diplomacy had been replaced by strikes. Now let me give you the historical context that is most directly relevant to what happens Sunday evening. The last 3 times the United States was directly involved in Middle East military action at scale, the Gulf War in 1991, the Iraq invasion in 2003, and the Soleimani strike in January 2020, gold gapped higher on the first trading session by between 1% and 4%. Silver followed with higher percentage moves in each case. In 2020, following the Soleimani strike, silver moved from $17 to $19 in 10 days, an 11% move, before broader COVID volatility overwhelmed the signal. But the precedent that is structurally most similar to the current setup is August 1990, when Iraq invaded Kuwait. Gold moved from $360 to $412 in the 3 weeks following the invasion, a 14% move in under a month. Silver moved from $4 to $5 over the same period, a 25% gain. The setup then included an already elevated precious metals environment, an inflationary backdrop, and an oil supply shock threatening to push prices significantly higher. The critical difference between 1990 and today: in 1990, silver was at $4 and had significant room below it. Today, silver is at $94. And the physical delivery data suggests very limited downside, because structural industrial buyers are continuously entering the market at any level below their production cost calculations. These are manufacturers who need silver to build solar panels, AI semiconductors, EV power systems. Their demand does not disappear because there is a war in the Middle East. Now here is the Strait of Hormuz dimension that connects oil directly to silver in ways that go beyond the obvious safe haven bid. The Strait of Hormuz is 21 miles wide at its narrowest point, between Iran and Oman. Approximately 20% of global oil supply transits through it every single day. Over $500 billion in energy trade annually. Iranian military doctrine, documented and publicly stated, includes mining the strait and using coastal missile batteries against tankers in the event of armed conflict. On February 3rd, 2026, 6 IRGC Navy gunboats had already attempted to stop and seize a U.S. tanker in the strait. That was 3 weeks before Saturday's strikes. None of the strait closure scenarios have activated yet, as of my recording, but the threat alone is sufficient to move energy and precious metals markets significantly. The mechanism connecting oil to silver runs through inflation. An oil price spike of 20 to 30%, consistent with sustained strait disruption, would push U.S. CPI and PCE prints significantly higher. That removes rate cut probability from the Fed's forward guidance, which further validates the stagflationary thesis already driving precious metals allocation by institutional money managers. Higher oil prices also directly increase mining input costs, which compress margins for lower-cost producers and accelerate the case for higher silver prices as the economic threshold below which production becomes uneconomic moves upward. Copper, at $5.97 to $6.14 per pound, near record territory, is worth noting in this context. Copper and silver have extensive physical overlap. Both are produced as byproducts of base metal mining. Both have critical industrial applications in electrification and energy transition. Both face the same China export control risks. A copper market at record prices simultaneously with silver at 94 is telling you that the industrial metals complex as a whole is pricing in a supply-constrained world. This is not a rotation from one metal to another. It is a repricing of the entire physical commodities complex. Bitcoin, by contrast, fell to $65,500, down 3.2% in 24 hours, extending its decline from $83,000 in late January. The divergence between rising hard assets and falling crypto is a classic flight to quality rotation. In 2021, Bitcoin and silver moved together as retail investors treated both as inflation hedges. The decoupling in 2026 suggests institutional positioning is driving the precious metals move rather than retail speculation, which is consistent with the COT data showing hedge funds still dramatically underweight. I want to pause and be precise about what we know and what remains uncertain. The strikes happened. The retaliation happened. These are confirmed by multiple credible news organizations, including CNN, Reuters, NPR, Al Jazeera, and Times of Israel. The Strait of Hormuz is within range of Iranian military assets. Those are facts. What we don't know, how this escalates or de-escalates over the next 72 hours, whether the strait gets disrupted, whether diplomatic channels reopen. Markets will be pricing a range of scenarios Sunday evening, not a single outcome. And history shows that initial precious metals moves after Middle East escalations are sometimes partially reversed within 2 weeks, as the situation clarifies. That is a legitimate risk to hold alongside the structural case. What the current setup adds on top of historical precedent is a physical delivery situation that existed independently before the first bomb dropped. Those are two separate demand drivers stacking simultaneously. Back to the full picture. Let me cover the retail demand data and regulatory developments that most silver media handled superficially this week, but which deserve precise attention. The Perth Mint reported January 2026 silver coin and bar sales of 1,722,639 ounces, up 315% from January 2025, up 188% from December, the highest monthly total since May 2023. The U.S. Mint launched the 2026 West Point Proof Silver Eagle on February 26th. Priced at $173 each with a 500,000 unit mintage. Pre-orders had already reached 209,027 units before the official launch date. Over 40% of total available supply committed before the product was technically on sale. The U.S. Mint also reported that 2026 bullion Silver Eagles are already listed as currently unavailable on its website, a supply constraint with no modern precedent this early in a calendar year. Online dealer premiums for silver coins range from 15 to 25% above spot. The exchange for physical spread, the premium paid to convert a futures contract into physical metal for immediate delivery, expanded from its historical average of 25 cents per ounce to over $1.10. Silver lease rates sat at approximately 8% annualized versus a normal range of 0.3 to 0.5%. Refiner backlogs for 1,000-ounce bars persist as industrial and investment demand simultaneously exceed processing capacity. The ETF flow data completes the picture. Approximately $1.2 billion in net inflows entered SLV during the 5 trading days ending February 27th, following a $3.4 billion single-day inflow earlier in February that represented the largest daily inflow in the fund's history. Aggregate global silver ETF holdings fell to 815 million ounces on February 23rd, before recovering sharply to 834 million ounces by February 25th, an 18.84 million ounce swing in 48 hours. Sprott Asset Management doubled its at-the-market equity program for PSLV to $2 billion on January 20th, enabling the acquisition of approximately 18 million additional ounces of physical silver at the Royal Canadian Mint. PSLV structure matters here. Unlike SLV, PSLV's silver cannot be hypothecated or lent. Every ounce that flows into PSLV is physically allocated and removed from the lending market permanently. Now, there is one regulatory development that received almost no coverage in silver-focused media this week, but which matters structurally for how this market gets overseen going forward. Bloomberg Law reported that the Department of Government Efficiency has revived internal discussions about merging the Securities and Exchange Commission with the Commodity Futures Trading Commission. The CFTC is the regulator responsible for overseeing COMEX, enforcing position limits on silver futures, and investigating manipulation complaints. If the CFTC is absorbed into a larger, differently staffed agency during a period of peak stress in the silver delivery market, the regulatory oversight of exactly the mechanics we have been documenting, the exchange outages, the open interest collapses, the delivery surge, could be in transition at precisely the moment it matters most. The CME February 25th trading halt, which still has received no public explanation beyond technical issues, has generated no CFTC inquiry, no congressional hearing request in public records as of this weekend. That regulatory silence becomes more significant if the agency responsible for investigating it is simultaneously facing a potential organizational merger. There's also a tariff dimension worth noting. The Supreme Court struck down Trump administration EPA tariffs on February 20th in a 6-3 decision. The administration immediately reimposed tariffs under a different legal authority, Section 122, the same statutory tool Richard Nixon used in 1971 when he closed the gold window and imposed a 10% import surcharge simultaneously. The White House fact sheet on the new tariffs explicitly exempts certain critical minerals and metals used in currency and bullion. Silver bullion appears to fall within that exemption. But the tariff context matters for silver through a second mechanism. The tariff uncertainty has driven a scramble for physical precious metals into U.S. vaults specifically to avoid any uncertainty about whether tariffs might apply to future imports. When institutions fear that silver imported in 3 months might carry a tariff they cannot currently price, they buy today and take delivery today. That behavioral pattern is part of what explains the record delivery volumes in January and February. Treasury Secretary Scott Bessent made remarks in early February blaming Chinese traders for silver's volatility, an attribution that sits awkwardly alongside a Wall Street Journal profile describing Bessent as a self-described gold bug who considers gold the ultimate currency. Multiple pieces of congressional legislation are also circulating to revalue the Federal Reserve's gold holdings from the statutory $42.22 per ounce to market value, which at current prices would generate between $760 billion and over $1 trillion in fresh Treasury capacity. If gold is formally revalued, the silver price implications depend on whether the gold-silver ratio compresses or holds. At current ratio levels near 56, a gold revaluation to $5,500 implies silver at approximately $98. That is effectively where the market currently sits organically, without any formal revaluation having occurred. Now, let me give you the number that frames the entire structural argument, offered publicly by someone who has been watching precious metal cycles for decades, and I want to give it the precise context it deserves, rather than either dismissing it or amplifying it without examination, because how you process it depends entirely on the logic behind it. Stay with me. Eric Sprott published an interview with Kitco on Friday in which he gave a price target of $300 for silver, more than 3 times the current price. I want to address this carefully because the number is significant enough that it deserves honest analysis rather than reflexive amplification or dismissal. The last time Eric Sprott made a comparably aggressive public call on silver was in 2020, when silver was trading at $17. It subsequently reached $49.80 in under 18 months. That is not proof his $300 call is correct. It is context for how seriously his framework should be taken as a data point from someone with a documented track record of reading this market. The underlying logic is not complicated. If silver's real price is determined by the physical market rather than the paper market, and if the paper-to-physical ratio is currently estimated at 356 to 1, then any significant reversion toward physical reality implies multiples of the current price. The math is straightforward. What remains genuinely uncertain is the timeline and the mechanism by which paper and physical converge. Sprott Asset Management CEO John Ciampaglia described the silver rally at PDAC 2026 as a catch-up trade rooted in years of supply deficits. That framing matters because it removes the speculative narrative and replaces it with supply-demand arithmetic. Catch-up trades don't end when sentiment shifts. They end when the price reflects physical reality. And physical reality currently includes 6 consecutive years of structural deficit with cumulative shortfalls approaching 820 million ounces. The Silver Institute projects 2026 will be the 6th consecutive year of structural physical supply deficit. That is 6 years in a row where global demand has exceeded global supply. 6 years of drawing down whatever above-ground inventory existed. And the above-ground inventory is not a bottomless well. The COMEX data shows us exactly how much has been drawn down. 346 million ounces of registered silver in 2020. Approximately 87 million today, a 75% decline. That inventory went to manufacturers, to solar panel producers, to electronics assemblers, and once silver is incorporated into a solar panel or a semiconductor, it does not come back. Now let me talk about what the broader metals complex was already communicating before Saturday's events. Because the week ending February 27th was not a silver story alone. Platinum surged to between $2,362 and $2,382, up 3 to 4% on Friday. Palladium held at $1,770 to $1,810. Copper at $597 to $614 per pound, near record territory. All four metals rising together in a single session is the signature of macro-driven repricing. It means the move is being powered by falling real yields, dollar weakness, geopolitical risk, and stagflationary data, not by commodity-specific news alone. When silver, gold, platinum, palladium, and copper all move together, the denominator is changing. The dollar's purchasing power is being reassessed in real time across the entire physical commodities complex. And now add Iran, add the Strait of Hormuz inside a war zone, add the oil price mechanism pushing CPI higher, add the safe haven bid layering on top of the industrial demand bid, add the geopolitical premium that history shows arrives on the first trading session after a Middle East military escalation of this scale. Here's the point that pulls everything together. The COT positioning data, the Wheaton $4.3 billion commitment, the Endeavor supply disruption, the U.S. Mint selling out in February, the physical lease rates at 16 times normal, the vault drain, the Iran strikes, the Pakistan-Afghanistan conflict adding a second simultaneous geopolitical shock, the CFTC restructuring. None of these facts require each other to be true. They are independent data points from completely different parts of the system. The KOT data doesn't need the Iran war to be significant. The Wheaton deal doesn't need the vault drain to make financial sense. The lease rates don't need the geopolitical premium to signal distress, and they are all pointing in the same direction at the same time. That kind of convergence across independent data sources doesn't happen randomly. It happens when a structural shift is underway that is large enough to show up in multiple metrics simultaneously. Let me give you my honest assessment of what the Sunday Open could look like and what it means practically for every type of silver position. Because the answer is different depending on what you hold, and understanding that difference is the entire point of this final section. Stay with me. Let me bring this together. No hype, no doom, just what the data shows and what it means going into tonight's open. Here is what we know with documented certainty entering Sunday evening. The weekly close was technically strong, a $7 to $8 weekly gain, a bullish continuation candle on the weekly chart, gold-silver ratio compressing to 56 to 57, supporting the physical demand thesis over the speculative momentum thesis. The CODI report shows managed money at less than half the position size it held in July when silver was at $38. U.S. commercial banks net long for the first time in recent memory. Commercial shorts continuing to cover. Open interest falling while price rises. The signature of physical demand replacing paper speculation as the market's price-setting mechanism. The Wheaton $4.3 billion deal is the largest silver streaming transaction in history. The financial model only works at long-term silver price assumptions, meaningfully above current spot. That is $4 billion of institutional conviction staked on a structural silver bull market. That is not sentiment. That is committed capital with a decades-long time horizon. The supply side is under genuine constraint. Mexico, 22% of global mine supply, facing documented cartel-related disruptions. U.S. Mint Silver Eagles already currently unavailable in February. Refiner backlogs persisting. Silver lease rates at 8%, 16 times normal. And on Saturday, while every precious metals market was dark, the United States and Israel struck Iran under Operation Epic Fury. Iran retaliated. The Strait of Hormuz, through which 20% of global oil flows, is now inside an active conflict zone. A second conflict between Pakistan and Afghanistan is entering its third consecutive day of fighting. And COMEX must price all of it simultaneously when electronic trading opens Sunday evening. The precedent from every comparable Middle East military escalation suggests precious metals gap higher on the first session. The current setup, physical delivery stress pre-existing before the geopolitical event, is more structurally charged than any comparable prior episode. What does this mean practically for each type of position? If you're holding physical silver, bars, coins, allocated vault storage where your metal is specifically identified, You are entering Sunday's open with an asset that cannot be cash settled against your wishes, cannot be margin called, cannot be affected by an exchange technical outage, and participates directly in the physical premium that Shanghai is already paying $10 to $12 above Western spot to access. The geopolitical event adds a premium demand driver on top of a structural physical bid that existed independently before Saturday morning. Your edge is that you cannot be shaken out. If you're holding paper silver, futures contracts, SLV, unallocated accounts, you have price exposure with counterparty risk. In a normal week, that trade-off is manageable. In a week, when a COMEX trading halt has already occurred without explanation, when physical delivery rates are running at 98%, and when a geopolitical shock is being priced simultaneously, the counterparty risk component of paper positions is more relevant than it has been in some time. That doesn't mean exit. It means understand precisely what you own and what risks attach to it. If you have no silver exposure and you're watching this before Sunday's open, the question worth thinking through carefully is not, is silver expensive at 94? The more relevant question is, if the physical market is structurally tighter than any comparable period in recent history, and a geopolitical event has just added a premium demand driver on top of that physical tightness, what does $94 actually represent relative to the physical reality beneath it? Based on the paper to physical ratio, based on the 6 consecutive year cumulative deficit, based on what Wheaton just committed $4 billion to, based on what institutional delivery data is showing. The answer may not be that 94 is expensive. It may be that 94 is the price before the structural reality is fully reflected. I want to be precise about what I'm not saying. I'm not saying silver gaps 10% Sunday evening and never looks back. I'm not saying the Iran situation definitely escalates to full regional war and the strait closes. Geopolitical premiums in precious metals have a documented history of being partially reversed within 2 weeks as situations clarify and diplomatic channels reopen. That is a real risk that belongs in your analysis alongside the structural case. What I am saying is that the structural backdrop for silver entering this weekend was already the most constructive it has been at any point in this cycle. And the geopolitical event that occurred Saturday is landing on top of that structural case rather than creating it from scratch. The difference between the two matters enormously for how you size and how you hold. The people who come out the other side of this market are not the ones who traded it most actively. They are not the ones who reacted fastest to every headline. They are the ones who understood the structure, sized their positions correctly from the beginning so that a 35% drawdown could not force them out, maintained conviction through the manufactured turbulence, and held until the physical reality overwhelmed the paper market's ability to contain it. History is unambiguous on this. The manipulation was real. 8 banks paid $1.27 billion in settlements. JP Morgan alone paid $920 million. Deutsche Bank handed over 350,000 documents, including audio of traders discussing bending silver lower. And silver is still here, still in structural deficit, still being demanded by industrial buyers at rates the paper market never anticipated. The players are more sophisticated now. The tools are more precise, but the underlying dynamic has not changed. Structural undersupply creates the conditions. Institutional positioning captures the move. And retail participants who understand what they're holding are the ones positioned to benefit when physical reality ultimately dominates. March is the next chapter. 31 delivery days remaining. The delivery data will tell us whether the physical squeeze is building or whether February's managed resolution extends for another cycle. The Iran situation will tell us whether the geopolitical premium holds or fades. The COT data will tell us when the hedge fund money finally decides to re-enter. GoFinance will be here for every data point as it comes in. Here is what I need from you right now. Number 1, subscribe if you haven't already. The story moves in real time. Vault inventory updates, delivery notices, COT releases, lease rate movements, geopolitical developments, all of it matters and all of it comes out daily over the next 31 days. Number 2, drop a comment right now. Tell me where you're watching from and tell me your read on the Iran situation. Does this escalate further or do diplomatic channels reopen quickly? Do you think COMEX gaps 3% or 10% tonight? I read every single comment and this community's analysis shapes what I cover next. Number 3, think carefully about how your current positioning handles a volatile open. The history of geopolitical shocks and precious metals includes significant initial moves that are sometimes partially reversed. If your position size cannot survive a 20% drawdown in either direction without forcing you to sell, you're not sized for this market. The structural case is intact. The path to wherever it ultimately leads is not a straight line. Number 4, share this video. Because there are people in your network watching silver from the outside who don't understand that what happens tonight is not random market noise. It is the intersection of a multi-year physical delivery crisis, a historic institutional positioning shift, a record-breaking streaming deal, supply disruptions in the world's largest silver-producing country, and an active military conflict in the world's most critical oil transit corridor, all hitting the price simultaneously on the first trading session of March. That is not a normal market open, and it deserves to be understood correctly. The QT data shows the speculative fuel is fully loaded, but has not been deployed. The physical delivery data shows the demand is not slowing. The Iran strikes show the geopolitical premium is only beginning to be calculated. The Wheaton deal shows the smart institutional money has already placed its long-term bet. And the DOJ-driven CFTC restructuring shows the regulatory framework overseeing all of it is in flux at the worst possible moment. When COMEX opens tonight, none of the structural factors change. What changes is the price. This is Mark from GoFinance. Silver closed the week at 94. A war broke out while the markets were shut. COMEX opens tonight into the most charged silver market setup I have documented in this cycle. Subscribe, stay informed, and understand what you're actually looking at when the price moves.